Hi everyone, my name is Bruno. I'm a technical director at Input Output, and I'm going to present to you our stablecoin, which is a pegged and crypto-backed algorithmic stablecoin. This has been joint work with some amazing people from Ergo and Emurgo, and also other people from Input Output. So yeah, let's start. Let's start with some definitions to explain the title of this talk. So first, by stablecoin, we mean a digital asset having low price volatility with respect to another asset or index. Some examples of assets and index are, for example, the USD, Euro, even Bitcoin, gold, silver, stocks, indexes like the S&P 500, inflation indexes. We say that a stablecoin is pegged if it tries to keep the volatility as close as possible to zero. And we say that it's backed if it maintains reserves to enable the stabilization mechanisms. And we say that it's crypto-backed if the reserves are made of cryptocurrencies, for example, ADA or Erg. And finally, we say that the stablecoin is algorithmic if the stabilization mechanisms follow an algorithm. So before I explain the stablecoin to you, I would like to go over some principles and goals that have guided ourselves in the design. So first, of course, if we want to do a stablecoin, one of our main goals is stability. And we have to think about how we're going to stabilize the stablecoin, right? The price of the stablecoin. And one thing we could do is to make something very complicated and obscure so that you don't understand how it works, hoping that by not understanding how it works, you wouldn't be able to attack the stability of the stablecoin. Now, of course, I'm joking, right? We're not really going to do this. Instead, we are aiming to do something that where you can reason very clearly about the stability, so that you can be confident that it's stable, and you can be confident about the conditions under which the stability holds. And as long as these conditions are true, the stablecoin, the price of the stablecoin will be stable. When thinking about the stabilization techniques, we took our inspiration from well-established concepts and techniques from traditional economics and finance. So we tried to avoid reinventing the wheel, and maybe accidentally creating squares and triangles instead of wheels that don't really work, that are not really stable. So yeah, we try to use as much as possible techniques that already exist and that are already proven in the traditional economics and finance. Another very important goal for us has always been legal compliance. So let me be very clear, we have no intention of doing anything that is illegal. So all the decisions, all the design decisions that we have made in the design of our stablecoin have been with the goal of being legally compliant. So we have done our best to be legally compliant. And that's also one reason why we decided to take our inspiration from well-established concepts and techniques from traditional economics and finance, because we believe that this would facilitate legal compliance in the sense that because our stablecoin will be doing something that is already well known to the public and to regulators, it's more likely that our stablecoin will be considered okay from a legal point of view. One principle that we have always followed is simplicity. So we want our stablecoin to be simple to understand, and that's because it enables a clear reasoning about the stability of the stablecoin price. So we also believe that by making something simple, we will make the job of regulators easier, and this will facilitate legal compliance again. And finally, by aiming for something that is legally compliant, that is inspired by well-established concepts and techniques, and that is simple, we hope that our stablecoin will achieve wide adoption. So we hope that these principles and goals will encourage adoption of our stablecoin. And finally, we have managed to design something that is so simple that we can describe it to you in a single slide. So let's move on to this description now. So imagine that you have, we have our contract, right? Our smart contract. And we have some users interested in a stablecoin. So one thing that the users might want to do is to buy stablecoins. And they can do that by interacting with the contract. So they send $1 USD, $1 to the contract. And the contract sends one stablecoin back to the user. So it mints the stablecoin and sends the stablecoin to the user. And of course, you cannot send actual dollars to the contract because dollars don't exist on the blockchain, right? So instead, what you send is an equivalent amount of base coins, where the base coin is either ADA or ERG, depending on whether you're using Cardano or Ergo. And the conversion rate, this X USD BC, is provided by an oracle. So the price of the stablecoin usually is going to be $1 in base coins. And this process can be repeated, right? Users can send more base coins to the contract and get more stable coins. And in this way, the contract builds its reserves of base coins. Then later on, the users might want to sell stable coins. So they send, for example, one stable coin to the contract. The contract will get rid of this stable coin and will send back an amount of base coins that is equivalent to $1 to the user. Now, the problem is that because of the fluctuation of the price of the base coin, there might not be enough reserves to give back dollars for all the stablecoin holders. So in such cases, when the reserve becomes too low, what we do is to give a quantity of base coins that is equal to the reserves divided by the number of stable coins in circulation, this NSC. So of course, you're only guaranteed to get $1 back if there are enough reserves. And if there is not enough reserves, you get a bit less, but at least the distribution will be fair. So every stablecoin holder will have the right to the same amount of base coins. Okay, so this portion of the reserves contains base coins that are, let's say, reserved to pay back the stablecoin holders, is what we call liabilities. Now, since every time users are interacting with the contract, they are paying some small fees to buy or sell stablecoins, and also because the price of the base coin may increase, you may end up having a surplus of reserves. This surplus of reserves we call equity. So the equity is the reserves minus the liabilities. And note that because the price of the stable coin is this minimum between $1 and the total reserve divided by the number of stable coins in circulation, the equity can never go below zero, so we don't have a balance sheet insolvency problem. Now, even though we don't have a balance sheet insolvency problem, and this means that our contract cannot go bankrupt, when the equity goes down to zero, there's still a situation that is not so nice for the stablecoin holders, right? Because they would prefer to be receiving $1 and not less than $1. So to improve on the situation, we have a second type of users, and these users, they would be incentivized to provide more equity to the contract, so that even if the price of the base coin falls, there will still be enough reserves to cover all the liabilities to the stablecoin holders, so that they can get $1 for their stablecoins. So, and they provide this additional equity by buying what we call reserve coins. And the process is basically the same. So they provide some additional base coins to the contract, and they get back some reserve coins. So the contract will mint the reserve coins and will send these reserve coins to the users. And now, how much of the base coins do they have to send to the contract? That's determined by the price of the reserve coin, which is usually the current equity divided by the current number of reserve coins in circulation. So this is similar to what in the traditional financial world is known as book value per share. Now, because because the equity may go down to close to zero, if we just charge the book value per share for reserve coins, we might end up we could end up selling reserve coins for a price that is too close to zero. To avoid that, we have a minimum price for reserve coins. So the price of the reserve coin is the maximum of the book value per share, and a minimum price that is a parameter of the Stablecoin Protocol. Okay, so this process of the contract selling reserve coins to potential reserve coin holders is similar to what in the traditional financial world is known as equity financing. Okay, and similarly to stable coins, for reserve coins, the reserve coins holders can also sell reserve coins later on. So they send a reserve coin back to the contract. The contract gets rid of the reserve coin and sends back some amount of base coins to the user. Okay, and this process is similar to what is known as a buyback in the traditional financial world. Okay, now these four operations, buying and selling stable coins and reserve coins, they are not always allowed. So we have a quantity that we call reserve ratio, which is basically the reserve divided by the liabilities. And two of these actions increase the reserve ratio, and two of these actions decrease the reserve ratio. So for example, if you sell reserve coins, you're decreasing the reserve ratio. And we don't want to allow the reserve ratio to become too low, right? So the same for buying stable coins. Like if too many people buy stable coins, the reserve ratio will become too low. So at some point we forbid buying stable coins. So buying stable coins is only allowed while the reserve ratio is greater than a minimum reserve ratio threshold. That is a parameter of the Stablecoin Protocol. And similarly for selling reserve coins, it's only allowed when the reserve ratio is greater than the minimum reserve ratio threshold. We also forbid buying reserve coins when the reserve ratio is greater than a maximum reserve ratio threshold. And this may seem counterintuitive at first, because you may think, okay, we should just allow the reserve ratio to grow as much as possible, right? The greater the reserve ratio, the greater the stability. And that's correct. But the greater the reserve ratio, the more the interests of the reserve coin holders are diluted. So remember that an incentive that the reserve coin holders have is that thanks to the buyback, they are able to collect profits from the contract. So as people interact with the contract, fees are accumulated. And later, these fees can be obtained by the reserve coin holders when they sell their reserve coins. But if the reserve ratio is too high and there are too many reserve coins, then the amount of fees that are collected per reserve coin will be too low. So we don't want this to happen. We want the reserve coin holders not to be diluted. So that's why we only allow buying reserve coins when the reserve ratio is lower than a maximum reserve ratio threshold. With one exception. So if the time is smaller than a certain specified time, certain parameter of the protocol, then you can also buy reserve coins. And that's to provide the initial reserves to the contract when the stablecoin contract is being deployed, right after the stablecoin contract is deployed. If we didn't have this condition of allowing the buying reserve coins when the time is smaller than T star, then you basically wouldn't be able to initialize the Stablecoin Protocol, because all these conditions would be too strict, and you wouldn't be able to violate them. Okay, so that's it. The protocol is explained in a single slide. So let's move on to the next slide. So why is this stablecoin stable? Right. It's stable because it would be futile for someone to try to sell a stablecoin for more than $1, because potential buyers could just buy the stablecoin directly from the contract for $1 instead. And it would also be futile to try to buy a stablecoin for less than $1, because potential sellers could just sell the stablecoin directly to the contract for $1 instead. So everybody would be incentivized to trade stablecoins among themselves for a price that is approximately $1. Under which assumptions is it stable? So the assumption that the reserve ratio is greater than the minimum reserve ratio threshold, and that's because if this is not the case, then buy stablecoins directly from the contract is not enabled anymore. So this is a situation that may happen when there's too much demand for stablecoins, but not enough reserves. So you may end up having to buy your stablecoins in the secondary market for a price that is higher than $1. because the contract wouldn't be selling it to you for just $1. Another assumption is that the equity has to be greater than 0. Otherwise, selling a stablecoin directly to the contract would give the seller less than $1. And finally, another assumption is that there should be no more than negligible blockchain congestion, right? Because the stability depends on users being able to buy and sell the stable coins interacting with the contract. If there is blockchain congestion, they won't be able to interact with the contract quickly enough. Now, are these assumptions reasonable? So the sale of new reserve coins, which is somewhat similar to equity financing, encourages the maintenance of the reserve ratio and the equity conditions. And potential reserve coin buyers are encouraged to buy reserve coins because they profit from the accumulation of fees and because they are protected from dilution by the maximum reserve ratio threshold. Okay, so why did we choose a pegged stablecoin and why USD as the peg? So USD is the most popular peg for stablecoins nowadays. And there's still no USD pegged stablecoin on Ergo or Cardano. So we wanted to provide a USD pegged stablecoin because that's what the public is demanding, and we still don't have that on Ergo or Cardano. We also wanted a stablecoin pegged to a fiat currency because it's potentially useful as a means of exchange, right? Nowadays, we still use fiat currencies as a means of exchange in our daily lives for goods and services, and a stablecoin that is pegged to a fiat currency could be useful for those activities. And particularly a stablecoin that is pegged to the USD could be useful for people in countries with weaker currencies and higher inflation. So because we chose to have a pegged stablecoin and it's pegged to an off-chain asset, this means that we need an oracle. And yeah, there are some differences in how we are going to do oracles in Cardano and in Ergo, but this would be a topic for another talk. And it's important to note that our design could work with other pegs as well. So there's nothing specific about the USD. You know, we could have pegged it to the euro, to some index, to some inflation index, to a basket of currencies, and so on. As long as we have oracles providing the data that the contract needs, we could peg the stablecoin to anything. And I would like to say that even though we have chosen a pegged stablecoin, and we think that a pegged stablecoin addresses the short-term use cases better, I do think that in the longer term, unpegged stablecoins are also worth researching and pursuing. So why did we choose an algorithmic stablecoin? We wanted to demonstrate the capabilities of Cardano and Ergo and the contract languages, Plutus and ErgoScript. We wanted to demonstrate an algorithmic stablecoin on UTXO-based blockchains. So the UTXO accounting model presents some additional challenges when you're implementing the stablecoin, and we wanted to achieve that as well. Although we should also note that the design that I presented in the previous slides could also be used for an account-based blockchain as well. And also, an algorithmic stablecoin is more autonomous and hence requires less management and is less susceptible to misbehavior by a managing entity. So a managing entity cannot just run away with the reserves, for example. The reserves are there locked by the contract, in the contract. So I'm going to show you now some preliminary implementation in Plutus, just to give you an idea of how Plutus contracts look like, but I will not go too much into details on that. So here you can see in Plutus the state of the stablecoin being defined. So you can see that it keeps the reserves and the number of stablecoins in circulation, the number of reserve coins in circulation. Then you can see here the definition of liabilities and equity as I defined in the previous slides. Here you can see the parameters of the stablecoin. You can see that you have the minimum and maximum reserve ratios. You have the percentage fee that is charged in every trade. You have the base coin, the base currency that is used for the reserves. And down there in the slide, you can see the actions that are allowed. And you can see there just two actions, right? Mint stablecoin and mint reserve coin. And you can remember that in the slide that I presented a while ago, we had 4 actions. And the reason why we have just 2 actions in the contract is that the other 2 actions, you can just use the same 2 actions, but using a negative value, right? So for example, if you are buying stablecoins, then you use this mint stablecoin action with a positive value. But if you're selling stablecoins, you use this mint stablecoin action with a negative value. So the implementation is even more minimal than what I described in that single slide. Okay. So this shows what happens when you apply the actions of minting stablecoins or minting reserve coins. And finally, you can see here some code checking the conditions. For example, down there you check that the actual reserves must be greater than the minimum reserves calculated by the minimum reserve ratio, and it must be smaller than the maximum reserve ratio. Okay, now we continue to work on this stablecoin protocol. So some of the things that we're currently looking at include a debt to equity swap to obtain a smoother handling of balance sheet insolvency. We are looking at continuous pricing. So that buying n reserve coins at once will have the same price as buying 1 reserve coins n times. Currently, you can kind of get a discount if you buy lots of reserve coins at once. We're also looking at dynamic fees. This would mean fees growing linearly for buying and selling actions that move the reserve ratio away from an optimum reserve ratio. And the reason why we're looking at this is that it would provide greater robustness against oracle delays and against manipulation of the price of the base coin of ADA or ERG. We're also considering to include debt financing, so bonds in addition to equity financing, in addition to selling reserve coins. We could also replenish the reserves by selling bonds. We are considering dividends. In fact, the initial design of the stablecoin included dividends, but we removed that because there would be some scalability issues related to creating too many transactions to pay dividends to all reserve coin holders. We are, of course, interested in stablecoins pegged to other assets. We are also looking at reserves consisting of a basket of assets. So instead of reserves being only ADA or only ERG, we could also include other assets there. Yeah, pegging the stablecoin to other assets is trivial, but having a reserves consisting of a basket of assets is a bit more complicated because you have to think about the optimal basket composition. Okay, we have already done some stability simulations, but we intend to do more, and we also intend to formally verify the stability. We are also looking at governance and updates because, you know, the stablecoin has a few parameters, as you have seen. And the question is, how do you set these parameters, right? And one interesting possibility is to allow the users to update these parameters based on some governance mechanisms. We are also looking at KYC and AML. And one very interesting thing in the case of Cardano, we are looking at staking. So basically we can take all the reserve that is there in the contract and stake it and earn some rewards for staking and possibly distribute these rewards to stablecoin holders or reserve coin holders. So as I mentioned, we took most of our inspiration from traditional concepts and techniques from economics and finance. But of course, we also looked at all the stablecoins out there. We looked at dozens of stablecoins, and 3 of them were particularly influential to us. So one of them was seigniorage shares. So there are some similarities with ours, right? In seigniorage shares, the shareholders profit from the contract, like the RC holders, the reserve coin holders profit in our case. One difference is that in their case, profit comes from seigniorage, and in our case, it comes from trading fees. In their case, there's no backing, and stability is based on changing the supply of the stablecoin. So I do think that researching unbacked stablecoins is very interesting, but I think that it's harder to achieve stability in that way. So that's why we preferred a stablecoin that is backed. Another one, of course, DAI. So DAI is crypto collateralized, and this is similar to crypto backing, but not exactly the same. So there's a difference between collateral and reserve. I will not go into details on this in this talk, but it's a subtle but important difference. And I think it's important because when you don't have reserves but you have collateral, the contract could be interpreted as a kind of bank with 0% reserves, you know. And we were concerned about legal aspects related to this. So when you hold DAI, you cannot sell your DAI directly to the contract, except if you're a vault owner or if there's a vault liquidation auction. So in our case, the stablecoins are always sellable to the contract by anyone immediately. So we believe that this will make the stablecoins more attractive to potential stablecoin users. And on the reserve coin side, like in DAI, you are penalized for providing collateral, right? You have to pay the stability fee. Whereas in our stablecoin, if you're a reserve coin holder, you are rewarded for providing reserves. So you are rewarded because the trading fees are accumulated in the equity, and you can sell your reserve coins and get that equity. You can get that fee, those fees at some point. Another one that was highly influential for us was static coin and risk coin, and it was probably the most influential of these 3. So a risk coin is similar to a reserve coin. One difference is that the risk coin's focus is on the leverage that it provides over the base coin. Whereas in our case, the focus of the reserve coin is on I mean, if you're a reserve coin holder, your primary interest is to profit from the contract through the accumulation of fees, of trading fees, right? You also get a little bit of leverage, but that shouldn't be your main focus, I would say, if you're a potential reserve coin buyer. With Statcoin and Riskcoin, there's no dilution protection for Riskcoin holders, so there's no maximum reserve ratio. And there's no reserve protection for static coin holders, so there's no minimum reserve ratio. And there's no fair pricing of stat coins when the reserve ratio falls below 1. So this means that there can be bank runs, you know, like if the reserve ratio falls below 1, then the stat coin holders can run to sell their stat coins back to the contract, and the ones who manage to do that first will get more reserves than we'll get more base coins than the later ones. Okay, so in summary, the presented stablecoin contract takes some of the responsibility and role of banks or central banks, depending on how you look at this. It behaves a bit like a full reserve central bank-like autonomous entity using automatic open market trading and market making for stabilization, equity financing for replenishing the reserve, and buyback for rewards in the reserve contributors. And to the best of our knowledge, the implementation in Ergo is the first algorithmic stablecoin on a UTXO-based blockchain. And finally, a final remark, you should use and interact with this contract with caution, right? So you should keep in mind that you are interacting with an autonomous software entity that follows its rules blindly and irreversibly. The best we can do is to make the rules be like the traditional rules that are already accepted by society and regulators, and explain these rules clearly to you. So we can make an analogy with self-driving cars, you know. A self-driving car still needs to comply with traffic rules, and in our case, we are making our stablecoin in a way that complies as much as possible and as much as we know with the rules. But the builder deployer of a self-driving car is not the car's driver, right? And it would be strange to require a driver's license from the builder or deployer. So thank you very much. It was a pleasure to present the stablecoin to you. Bye.